This is going to be a really good presentation. Up here with me, we have Sam Callahan, who you just heard from, and we have Keith Laska. He's a professor at the Fordham School of Law, and he's the founder of LearnBitcoin.io. And I've been told that they have props, so this is going to be a good one. Big warm welcome for Keith and Sam.
Thanks very much, everybody, and thanks to Build for putting on such a fantastic event. It's great to see so many people here. I'll tell you, as you go to more of these Bitcoin events, I think you'll agree, Sam, they get bigger and bigger in different cities, so it's nice to have a tight-knit community where you can actually communicate and talk to people. Take advantage of that today, because it's really, really important. That's how you learn Bitcoin, by effectively having one-on-one conversations. So quick show of hands here. Who considers themselves kind of new to Bitcoin? Raise your hand if you're new. Really high, so I can just get a sense. Okay, and who considers themselves to be an absolute expert at Bitcoin? I didn't think so. Sam and I spent a lot of time putting this presentation or educational session together for you. We have interactive slides. We've got a bit of role play. We even have some props. So basically, we've injected what my financial advisor would say is an irresponsible level of risk in this education session, but we're all in on Bitcoin, so let's do this. Quick update for you on who we are. I'm the founder of LearnBitcoin.io. It is an educational platform primarily directed at financial advisors, legal and tax professionals. I started my career as an instructor of French and Italian at Phillips Exeter Academy, a high school up in New Hampshire. I've been in the tech industry for a couple of decades and left all of that to become a professor of Bitcoin and blockchain at Fordham Law and Gabelli Business School over in Fordham. And I'll just let Sam introduce himself briefly.
Yeah, I mean, you guys just met me last talk, but I'm Sam Callahan. I'm the lead analyst at Swan Bitcoin, a Bitcoin financial services company, and I'm the host of a Bitcoin podcast called Swan Signal Live.
Great. Okay. So whenever I've taught the topic of Bitcoin to audiences like this, or even in schools, I tend to try to agree that there's a covenant or a contract between the audience and us. And that covenant or contract is, it takes three things to really open up your viewpoint on Bitcoin. The first is you need time. We have an hour today, but it took both of us probably a combination of 800 hours to get to where we are today. And it's literally like drinking out of a glass that has a hole at the bottom of it. Any Bitcoiner here will tell you that. You're learning new things every day from the community. The second is intellectual curiosity. Just bend your mind a little bit further, right? You have been living under a system that has effectively kind of kept you as slaves, so to speak. And the freedom opportunity is Bitcoin. And the third is an open mind. Be open to different viewpoints and be able to debate and discuss these viewpoints with everybody here. Any Bitcoin will tell you that there's a sentiment in the air right now. There's a beautiful smell. And that beautiful smell is Bitcoin at $35,000 per coin, right? But we have been through this before. Many of us that have been involved in Bitcoin know we've been there in 2013 maybe, or 2017, 2021. There's always a top and there's always a bottom to Bitcoin. The FOMO builds as the price increases, and then the fear builds as that price drops. Ultimately, something is changing. We have billionaires, people who lead in the financial industry, who are changing their tune about Bitcoin. We have the CEO of quite possibly one of the largest asset managers in the world, who's turning around just a couple of weeks ago and telling mainstream media that Bitcoin is a flight to safety. We have Fidelity that has released paper after paper after paper talking about the sound money characteristics of Bitcoin as money and really kind of separating Bitcoin from the rest of the pack, all of these other coins that get delivered onto the market in the thousands. And then we have Paul Tudor Jones who's saying, hey, look, we might be coming up to a recessionary time. You should probably allocate a little bit more to gold and Bitcoin. So ultimately, why are they just not providing a soundbite for a news clip? Why are they going online on CNBC? And why are they going online and being interviewed at Fox? It's because they see something that maybe we don't yet. Maybe they see that over the past 10 years, Bitcoin has actually proven out a CAGR of almost 200%. You compare that to juicy returns from Amazon and Tesla, and it's nowhere near that category. Maybe it's because there's excitement about potential spot Bitcoin ETFs coming out into the market. There is $20 trillion of asset management sitting behind 8 Bitcoin spot ETFs, and if those are approved, they're expecting somewhere, again, not financial advice, between $150 to $200 billion of inflow into these spot Bitcoin ETFs over the next couple of years. Or maybe it's not greed. Maybe it's fear. Maybe they're seeing what we're kind of feeling, which is the US is now $33 trillion in debt, and by the year 2050, we're expected to have debt in excess of 180% of GDP. What does that mean for our kids, our kids' kids? It means by the time we get to 2050, each individual in the United States is going to owe $250,000 in debt. We have a big problem on our hands. So what do these financial stalwarts know that we don't? In this educational course today, it's not a presentation, we're hoping you get 2 things. The first is that this is the start of your Bitcoin journey. It never, ever, ever ends. I was literally on X 20 minutes ago and I learned something I didn't know, okay? And I teach this stuff. So it's a never-ending journey. Don't feel bad if you only got a fraction of what we're going to talk about today. You start your journey here. The second is that you're empowered to hold good, powerful, educated conversations about whether Bitcoin is a good investment or not. What I say to people is, it doesn't make any sense as a financial advisor, for example, for you to say to your client that Bitcoin is a fad, or to say to your client that Bitcoin is a good buying opportunity if you're not educated. Education is the foundation of all knowledge. Okay. We've broken up this education session into 4 components, so you know where you are at any given point. Parker did a great job with Sam in covering off the macro. I'm just going to do a high level for you just to show you where we are today, talk a little bit about characteristics of sound money, and then relate that back to Bitcoin. And then we'll kind of carry on with our lesson plan. 2 words I'd like you to memorize today. The first is credito. It's the Latin word for faith or trust. All money throughout society, throughout all history and time, has been based on nothing more than faith and trust in the money that you're using. And the second is fiat. When you hear that word, you probably think US dollars, or maybe euro, or yen, whatever it happens to be. But fiat, the actual definition of fiat is, it shall be, or authoritative control. So in other words, we are being demanded to use the currency we use. We don't have a choice. Whenever I teach at Fordham, the first few classes I bring all my students through this process. We talk about sound money characteristics. Arthur Laffer said that sound money is the sine qua non of a prosperous society. It's the backbone of a prosperous society. Whenever hard money breaks from a currency, you get issues like you had in ancient China, where inflation kicked in. The Roman Empire was pretty much toppled through devaluing their currency. Weimar Germany and hyperinflation, Zimbabwe, you name it. Whenever you start to manipulate a currency, you end up with situations that become out of your control as a nation. So I ask my students, let's go through history and try to take a look at different forms of money and rate them as to whether they're hard money, proper, sound, hard money characteristics, or whether they're weak. And I always use a cow, this poor little cow, as the example, right? Is a cow durable and portable? Like, we're talking about hunter-gatherer societies. Would you lift a cow up and bring it to the next village for trade for a couple sheep and chickens, right? Very hard to do. Is it divisible? Somewhat, if you like steak, right? How uniform is a cow? Well, they come in all different shapes and sizes, so not necessarily uniform. Limited in supply. If cows really became valuable, you just kind of make more cows, right? And then is it accepted everywhere? So we've gone through this process, and this is the result of hundreds of students. Some of these students, by the way, are in business schools. Some of these students actually have jobs in compliance and banks, so on and so forth. And they have rated money over time. And of course, hunter-gatherer societies, very weak money. And then we start to see some strength here as we move towards Roman coins, but of course the Romans started diluting their gold and silver, which led to their collapse. We then look at the initiation of paper money, which was backed by commodities initially. And then we have the Medici family, who created really the first banking system. We had an element of a gold-backed currency for a period of time. Ask your grandparents or your parents, depending on how old they are. You know, they remember a day when they had gold in their houses. They remember a day on April 5th, 1933, when the federal government told them, bring in your gold or you're getting arrested and fined. They remember then getting a gold certificate instead, saying, well, I guess I still have gold, right? It's a certificate. Then they remember gold depegging from the US dollar in 1971. Your grandparents would probably get Bitcoin before anybody else. They knew a day where there was ultrasound hard money. This is what's most interesting. These students, early on in my courses, have effectively seen a deterioration in trust and faith in the current money system. Bitcoin is the opposite, and we're going to talk about that with you today. Bitcoin is digital. It's durable and portable. You can move it anywhere you want, obviously on a hard drive, and even if you don't have that hard drive, if you remember your passphrase, your keys, you can actually access your Bitcoin anywhere in the world. It's divisible. Most people don't realize this. You look at the price of Bitcoin at $35,000, and then you say, I can never afford one of those. Bitcoin is broken into 100 million units. You can go right now and buy $2 of Bitcoin if you wanted to, and you're now participating in the network. It is heavily limited in supply. 21 million coins will ever be mined, and we're going to talk about that process in a second. And finally, not that accepted, but we're working on the on-ramps. So what are the functions of money, and what is Bitcoin? Do you hear people say, I don't understand the use case? It's the first thing I hear when I talk to people. Actually, when I talk to people, they say, get out of the industry. The next thing I hear after that is, what's its use case? And these people don't understand, okay? There's a store of value, medium of exchange, and a unit of account. In a low time preference society, here in the United States, our focus is on annual returns, decade-long returns, maybe even generational wealth transfer, okay? For us, Bitcoin might be seen more as a savings technology or a store of value. But if you ask the Argentinians, who are faced with 130% inflation, they're not worried about annual returns. They're worried about eating that night. To them, running away from the Argentinian peso and putting their money into a more sound storage like Bitcoin is much better, but they're still using it as a medium of exchange and not necessarily as a savings technology. And then you have El Salvador, right? A couple of years ago, 25% of their GDP was remittances, sending money back and forth, primarily to the United States, and they had the highest crime rate pretty much in the world. They adopted Bitcoin almost as an escape hatch. Now, if you actually look at the progress in El Salvador today, it is significant, and I'm not saying it has uniquely to do with Bitcoin, but certainly property values are up. You know, people are visiting more often. They're actually transacting and using Bitcoin as a medium of exchange and unit of account. But to me, the most valuable part of Bitcoin is its scarcity. Parker said this, I think, 3 times just before I got on stage. Scarcity is everything with Bitcoin. We have some financial advisors in the audience. We also have people who invest, right, either for a living or are seeking to get good returns. We know this. Your financial advisor or anybody who understands investments will say, do not keep your money in cash. It's constantly devalued. In fact, our system is set up for inflation to deteriorate the value of our cash over time, right? That's clear as day. And then what they tell you, and this is understandable because there wasn't another option, is put your money into the stock market and put it into gold. The problem is, if you actually set your basis for gold and the stock market in US dollars, you're still swimming up a waterfall because the US dollar continues to get debased over time. The only asset, the only bearer asset that has the highest potential, in my opinion, for growth is Bitcoin with its limited supply and its scarcity. Okay, so now we're going to go on to how Bitcoin works. There's some split opinion in the community as to whether I should go into this level of detail on the Bitcoin network. Usually this kind of is like a 102 or a 103, but you guys are smart. And my view here is you're going to follow the price of Bitcoin. It's going to shoot up and you're going to get greedy. It's going to drop down and you're going to get scared. And if that's all you associate Bitcoin with, then you're actually going to leave the project. You are. I've seen it 100 times. If, however, through that volatility, you understand how Bitcoin has the potential to replace banks, that is a level of conviction that you can hold on to for some period of time, and I call that the sand in the fishbowl. So putting the volatility of the price aside for a second, if you understand this novel innovation that was created in 2008, you're going to hold on to that through thick and thin. So here's a question for you. This is something that Bitcoin looks to solve. How do two independent parties, Sam and I, who don't trust each other, we don't, we don't trust each other, how can we actually transact and come to consensus on that transaction without a third party today? Practically impossible. If I'm going to send Sam, apart from cash, of course, and I still have to go to the bank and request my own cash out of the bank, and they have to approve it. But ultimately, I'm going to send him a Venmo, or I'm going to wire some money, or I'm going to ACH some money, I'm going to use a credit card to buy from him. I, in every single case, have to go up to a central authority to get permission to send money or something of value back down to Sam. And there was this anonymous individual who posted on a message board, almost 15 years to today, by the way, 15 years to this coming Tuesday, Halloween 2008. And this individual said, I've been working on a new electronic cash system that's fully peer-to-peer with no trusted third party. This was Satoshi Nakamoto, the anonymous inventor of Bitcoin, clearly a cryptographer. We don't know really who Satoshi Nakamoto is. We have some views, we've had some discussions on who we think Satoshi Nakamoto is. It could be a man, it could be a woman, it could be an organization, it could be a country, we don't know. And it doesn't really matter. What does matter is Satoshi was absolutely fascinated with the concept of removing the bank from the process of transacting, okay? It's actually quite a hard thing to do, and we're going to talk about just how innovative this solution is, this invention is, and hopefully you understand that by the end of this particular section. So Satoshi effectively said, what if we don't trust one entity or one person, me going to a bank, right back down to Sam, but instead we decided that we were going to trust everyone involved in the process. This is called the consensus protocol, or Nakamoto's consensus, and we're going to walk through it with you today. Starting with the basics. Just like a credit card transaction or a wire transfer to a bank, Bitcoin has a ledger, and it basically processes transactions in blocks. These blocks hold about 2,500 transactions every block, okay? And they get processed every 10 minutes. So when I transact with Sam on the Bitcoin network, it's my transaction waiting to be processed and about 2,499 other transactions to be processed. Once it does get processed and validated, the chain allows all of the other transactions to be seen and confirmed, and they all reference each other. So you know immutably that it is a valid transaction and it's posted on the blockchain. For all those who didn't know before, this is where the term blockchain comes from. A block that needs to be processed, and it gets attached to the chain. The other cool thing about this is it's online, it's publicly available. It is like an online version of an Excel spreadsheet, okay? Let me ask you this. You can see every single transaction since the start of the Bitcoin network online. You guys can all query it right now. If you walked into your bank and you said, hey, I want to see all the transactions that not just I've done with your bank, but everyone you've ever transacted with since the history of time, like 1882 for some of these banks, right? Can you show me all that data and can you just post it publicly for me? No, I don't think so, right? So this is step one, really novel invention, a public ledger that effectively allows you to see every single transaction. Is it anonymous? Kind of. If you know my wallet and you know who I am, and you've linked my name to that wallet, then it's no longer anonymous, right? But for many people, it can be anonymous. So we're going to talk a little bit about why people are mining on the network now. We've talked a little bit about blockchain and these transactions that are getting processed every 10 minutes. In order to do that, we have these miners, all right? They're on the network, and this isn't gold mining. They're not using pickaxes. They're actually downloading Bitcoin software, to make it simple, onto a computer. And they're all attaching themselves onto this network to process those transactions. So actually, you know what we're going to do? Let's bring some people up right now. Do you guys want to engage in this little experiment? You guys want to have some fun together? Yeah. All right. Who wants to win? What's the price right now? $35,000? Who wants to win the equivalent of about $200,000 in Bitcoin right now? Raise your hand. Up high. All right. There's one person can come up. Let's go. Number two. Who else? You raise your hand first. You're eager. Let's go. We need two more. Two more. Any students want to? Oh, we've got a student. That's great. Come on down. One more person. One more person. We're going to start to voluntold soon. There we go. You can come up. All right. Yeah, this is exciting. All right, here we are. This is a Bitcoin. This is an absolutely authentic, fake Bitcoin. And it's worth, at today's price, about $35,000, okay? Every 10 minutes on the Bitcoin network, we talked about this block entering into the chain. Every 10 minutes, one miner, or maybe a group of miners working together as a team, they actually win the equivalent of $200,000 in Bitcoin every 10 minutes. This is why you have people mining. This is why you have public companies who are mining. It's a big, big business. So you guys ready to win $200,000 in Bitcoin? You are, okay. This is what you have to do. Come on. We have 5 Rubik's Cubes right here. I'm going to give you one. There we go. I'm going to give you one. Now, nobody cheat yet. Don't start. Do we have our 5th person up here? That's you, Sam. There you go.
I'm a minor now.
Oh, there you are. Come on up. Yeah. There we are. Got a student. So basically, these are miners, all right? They have downloaded Bitcoin software. They have attached their computers to the network. And in some cases, they have spent millions and millions of dollars attaching their computers to the network. Because with Bitcoin, the winning of a reward every 10 minutes is a combination of effort, how much energy you apply to the network, how much you spend, right? And then also luck. Because what Bitcoin does is it basically generates a random mathematical puzzle every 10 minutes in these blocks. And all of these miners are basically throwing guesses to try to figure out the answer to that random mathematical puzzle. And the miner that actually wins will get their deposit of 6.25 Bitcoin, or in today's terms, $200,000, plus the transaction fees, okay? So we're gonna start right now. The first, don't cheat, no cheating. There we go. The first person to win, please raise your hand in the air showing us the solved Rubik's Cube. Let's go. You can bet on this if you want, by the way.
Do you know how to do that?
You got it. Oh! Oh my goodness, guys. I did not cheat at all in setting those Rubik's Cubes up due to time allotted. Okay. Now, what's your name? Joan. Joan has just solved this complex mathematical puzzle and raised her hand in the air to all the other miners to say, I have won, give me my $200,000. You want to hear something beautiful? Any one of these miners can turn around and say, I reject your solution, if they wanted to, okay? They can say, I'm going to cause a problem on the network and say no to that particular solution. Anybody want to guess why they won't do that? Yes, game theory at play. They can either cause a problem in the network, congest it, and stop it, or they can go, hats off to you. Joan, you won fair and square. I'm going to concentrate on what? The next block, where I can get another $200,000 in Bitcoin. So there you go. Joan gets her Bitcoin, she's happy, and Joan, along with everybody else, is now going to concentrate on validating the next block 10 minutes from now. Pretty cool. All right, thank the participants here. You get to keep the Rubik's Cubes. Go ahead. Those are yours. You guys want a Bitcoin? Take one of these. You guys can take one of these. There you go. Okay. So what actually happened there? Every 10 minutes, a whole bunch of miners are attached to the Bitcoin network, and they're supplying varying levels of energy, if you will, compute power to that network. Most of the time, I'll be honest with you, there are these large pools of miners, right, that all team up together. They win the block reward subsidy, the reward. And then that reward gets split between a whole bunch of people. But every once in a while, there's some person sitting in their basement, right, running it on a computer, basic computer, whatever it happens to be, some simple kit, and they win. And I'll tell you, the entire Bitcoin community celebrates when a solo miner actually wins that reward, because it used to be like that years ago, and because of the maturation of the industry, it is no longer like that. So basically, that one miner wins, and then the process starts over again, 6.25 Bitcoin, 6.25, 6.25, on and on again, solving those mathematical puzzles. We have replaced the banks with a decentralized network based on economic incentives. Tick-tock, next block. This happens every 10 minutes, 24 hours a day, 7 days a week, 365 days a year, and will never stop as long as somebody is running Bitcoin software. This is what we did. Instead of me sending some money over to Sam and trusting the banker who's going to buy their Cristal champagne and cigars and expensive whiskey, we said, no. I want to trust everyone in the network to come to consensus that this is a valid transaction and send that money over. So what happened at the end of the day? This is the power statement here. One central authority was basically replaced by thousands of decentralized participants on the network. Those banks were receiving all those fees and all that money for doing that fun money stuff. And now that money is dispersed amongst a decentralized community. That is the power of Bitcoin. And for anybody in this audience who knows the answer to this, does anybody know what that's called? That consensus protocol is called, what do we call that? Yes, thank you. Thank you so much. This is called proof of work, because you're working very hard with all your energy and compute power to prove out an equation that you should validate that block and get that reward. Okay? Everybody following so far? Is that okay? Okay, good. I'm just going to finish off briefly on Bitcoin economics, then hand over to Sam. Here's the cool thing. If you thought that was innovative, if we took an entire money system and basically made it decentralized, wait till you see what else is built into the network, because this is where it gets fun and a bit greedy, I guess, in some ways. So the other cool thing about this, we talked about 2,500 transactions every 10 minutes. And how many Bitcoin did we talk about? Everybody remember? 6.25 Bitcoin. That wasn't always like that. So when the protocol first launched by Satoshi Nakamoto himself and started mining blocks and validating blocks, you actually got 50 Bitcoin per 10-minute block. It's a lot of Bitcoin. Some very lucky people early on. But then something happens. Roughly every 210,000 blocks, or in people terms, that's 4 years, the supply of Bitcoin every 10 minutes gets cut in half. So in 2013, you only got 25 Bitcoin for coming up here and solving that Rubik's Cube puzzle. And then in 2017, only 12.5 Bitcoin. To today's lesson, 6.25 Bitcoin. And the question you might be asking yourself is why are these miners spending all this money if they keep getting less and less and less Bitcoin? Inevitably, some of them do go out of business, but this is why. Supply and demand is fully in force here. The price of Bitcoin, when you were getting 50 Bitcoin per 10 minutes, was like a penny, okay? The top in 2013 was around 1,200 when you get 25. At 12 and a half, it was 19,000 at the top. And then this last bull run, this last hype cycle, you had a price of $69,000, only 6.25 Bitcoin, okay? So you have economic incentives and the law of supply and demand working here. The beautiful thing about this is the price is completely elastic. If you've ever heard Michael Saylor speak, he's talked about, you know, it's going up forever. The price of Bitcoin is going up forever, Laura. We've heard that many times, right? What he's actually saying here is if the supply consistently gets cut in half, and even if the demand remains constant, the price has to go up on our little XY axis, right? But if the volatility is added to that, there is no equilibrium. There is no finite price of Bitcoin because you have supply continuing to decrease and you have demand continuing to increase. So that equilibrium, that dot plot of the right price for Bitcoin doesn't exist, nor will it ever, okay? If you walked into a meeting with the Federal Reserve Chair, our friend Jerome Powell, JPOW on Insta, and you said to him, this is all really interesting, thank you for dot plotting inflation for the next couple of years, but let me ask you a question. Can you tell me exactly what the inflation rate's gonna be in 2028? He'd stare at you like you were crazy. Well, how about 2032? 2036, 2040? Bitcoin's inflation rate is fully baked in and hard-coded based on math. I can tell you exactly what the inflation rate is going to be in 2028 because it's basically baked into Bitcoin's code. And here is another look at Bitcoin's halving periods, or we call them epochs or phases. You'll see by the year 2140, the last Bitcoin of the 21 million will have been mined. And actually, I think it's going to take like 10 or 15 years for that last one Bitcoin to be mined because we're dealing with infinitesimal numbers at that point in time. So after 2140, no more Bitcoin will be mined. The full 21 million will be out there in the market, and then miners will more likely than not move to getting paid for transaction fees only on the network. Okay, that's it for the education part that I'm covering. Hand it over to Sam.
Thanks, Keith. Let's go to sit that one.
Got a big one, yeah.
All right, thanks, Keith. Hopefully that gives a better overview of how Bitcoin actually works, kind of getting into the weeds a little bit. I'm going to talk about some of the fun stuff, some of the price performance that's occurred over the last few years, as well as how it fits into a portfolio. Like Keith said, we have a digital, scarce money that could be sent anywhere at the speed of light. That's the innovation, peer-to-peer, without any trusted third party. At a fraction of the cost, I can send money over the internet that can't be manipulated and can't be inflated. That's how I would summarize that talk, and that's pretty exciting. It's never existed in the history of the world. Now, when we look at the price performance, this is where it gets exciting. Look at the scoreboard. Bitcoin is the best performing asset 10 of the last 13 years in terms of total returns. Say that again. 10 of the last 13 years, Bitcoin has been the best performing asset out of every other asset class. And so if you're feeling like you missed out, don't feel that way because it's just getting started. This year it's continued. Bitcoin is the best performing asset this year. This week, it's shot up about 15%, so it's up about 105%. This chart's already outdated. Now, Bitcoin has fundamental different value drivers than other asset classes. Stocks, bonds, commodities, they're driven directly by government and central bank policies. Bitcoin's monetary policy, as Keith alluded to, is independent of that. It's fixed. It's also driven by things like earnings, profitability. It's directly impacted by the economy, production, function of supply chains. That's what drives stocks, bonds, and commodities. Bitcoin's value is driven by its scarcity, as well as its network effect and a demand for inflation-resistant digital money. Now, we talk about network effects. Network effects are fundamental to every platform business today. Think Meta, think Google. When you break down a network effect, what it means is that the value of a product or service becomes more valuable the more users that join that product or protocol. Now think of this like the telephone. The telephone was valuable, not as valuable in the beginning though. So when there was only one person that could call one other person, that telephone network wasn't that valuable. But as more people joined it, and you could call anybody in the world, that network became valuable over time. Now, Bitcoin has the same benefits of a network effect, except you can actually own a piece of that network itself. So Bitcoin's network effect underlies its growth and value. As Bitcoin's users have increased, the value of Bitcoin itself has also appreciated. This chart shows the number of people that hold at least $100 in an address going up to the right. It's a good metric to kind of symbolize Bitcoin's network growth. Now, Bitcoin's network isn't just the users, it's also the brand, the developers, the miners, the merchants, the exchanges. All of that creates a moat where other digital assets find it really hard to overcome or compete with Bitcoin. A knockoff can't copy this network effect. Similar to how somebody can't just fire up a new search engine and compete with Google. Like, try that yourself. You probably have a really difficult time. People start to use your, new search engine as a verb. They're not going to say, hey, use Sam's search engine to Google whatever. They'll just say Google, and they'll just go and use it. So why can we expect this adoption to continue? Well, demand for Bitcoin is a function of its environment. And today, when we look at the environment we're in, the world is plagued by stubborn inflation, monetary debasement, extreme fiscal spending, increasing financial censorship, bank failures, and other macroeconomic challenges. I'd say demand for a money that is censorship resistant, that can't be inflated, and is resistant to debasement, there's going to be more demand for that in this kind of environment. But also, demand for Bitcoin depends on the needs of each user, increasing its total addressable market. What I mean by that is Bitcoin is a digital store of value that can't be inflated, similar to a digital gold. It'll likely eat into the market share of digital gold. Corporate treasuries will begin to allocate part of their treasuries to Bitcoin, similar to MicroStrategy. Some institutional investment will occur from it. Some people use it for its Caesar resistance or its censorship resistance. Some people use it because it's cheaper to send remittance payments with. All of this results in increased demand for Bitcoin. And when you couple this increased demand for something as scarce as Bitcoin that can't be inflated away, well, you start to see the asymmetric opportunity of an asset that's still smaller than one single company like Apple today in terms of its market cap. This is a projection from ARK Invest, and they are making just a couple assumptions in terms of, hey, let's see if it takes 50% of gold's market cap, only 5% of corporate treasuries invest some of their cash in it, and let's say that it takes about 10% of emerging market currencies because they're failing all over the world. What could the price of Bitcoin look like? They came out to 1.36 million per Bitcoin by the year 2030. And it might seem outlandish, but when you think of all these demand vectors together with something as scarce as Bitcoin, you start to see the opportunity. Now, this gets brought up. Bitcoin is a flight to quality by Larry Fink. Well, you have to ask yourself, not that Bitcoin is a quality asset to invest in, but what are they fleeing from? Well, they're fleeing from something that used to be considered safe, that hasn't been the last 3 years, which is the Treasury bond. That is down 3 consecutive years for the first time in its history. This is supposed to be the asset that is used in all corporate treasuries as safe, and yet it is having the worst year since 1788. Stocks and bonds declined in tandem for the first time in a long time in 2022, and that disrupts current portfolio strategies. Why did that happen? Why did the correlation shoot up positive where stocks and bonds fell together? So bonds are not a good diversifier anymore as it has been in the past 2 years, and the reason being is because of inflation. A study recently by AQR Capital found that inflation, when it goes up, that's when this relationship starts to become positive, because stock prices historically fall during periods of high inflation, as well as bonds. It's a fixed income asset. The nominal cash flows get eroded away directly from high inflation. So in periods of high inflation, we start to see bonds and stocks move in tandem. And that's going to change how money managers have to think about diversification when it comes to their portfolio. So if inflation is going to stick around, we have to think about why that might be. Now we can talk about deglobalization, we can talk about demographics, but the thing that we focus on today is the money printing. This is the CBO's own projections of deficit spending over the next couple of years. It's supposed to be around 5% of GDP annually and growing for the foreseeable future. Trillions of dollars of fiscal deficits. It's really difficult to see how inflation is going to come down meaningfully and sustainably when you look at these projections from the CBO. This is the CBO's own projections for the debt. It says US public debt is going to rise by $5.2 billion every day for the next 10 years. And that's the CBO's projections. I would say those are quite conservative. And so if we know that they're going to spend, we can bet that inflation might stick around, and that's going to change how these bonds and stocks move. That has caused investors to embrace alternative assets amidst the rising inflationary pressures. You see it everywhere. You see it in family offices, endowments, pension funds, high net worth individuals. They are all turning to alternative assets, increasing their allocations out of fixed income in preparation for a more high inflationary regime. The case for Bitcoin gets stronger because not only has Bitcoin outperformed all the other asset classes, but over its 14 years history, it has demonstrated a very low and slightly negative correlation to most major asset classes. When you look at the rolling 90-day correlations of Bitcoin with other major asset classes, you can see it hovers between 0.3 and negative 0.3 over a 5-year time period. And as you go out farther, that actually gets even less correlated. And that's all the major asset classes that typically make up a traditional diversified portfolio. So the rationale for allocating Bitcoin is the same for all alternative assets: diversification and enhancing returns. Now, traditionally, in times of inflation, investors have turned to fixed supply assets like real estate, dividend-yielding stocks, and precious metals like gold and silver. But this time around, investors could turn to a new type of fixed supply asset, one that has significant growth potential due to its rising adoption and its network effect that we discussed before. The reason that Bitcoin has this is because of those different value drivers that I mentioned earlier in this presentation. So let's do a little case study, because we were going to look at a 60-40 portfolio, something really basic, but we're going to look at over the last 5 years and have a portfolio with 1% allocation, just 1%, 5%, and 10%. If you look at the annualized return, by adding Bitcoin, even a small fraction of it to the portfolio, it not only increased the annualized returns, it barely moves the annualized volatility of the portfolio, and it increases the Sharpe ratio. Sharpe ratio is just a measurement of the excess returns for a given amount of volatility, aka is the return worth the risk that's added to that portfolio? So not only did it increase the returns, not only did it barely move the volatility, even though Bitcoin is more volatile, it also reduced the risk of the portfolio. Now, that's a really basic portfolio, and there's some pension fund managers in here, so we actually did the same thing with the Ontario Teachers Pension Plan portfolio. Now, they invested in something like FTX, lost a lot of money when they should have just invested in Bitcoin. This is just a basic portfolio, really standard for a lot of pensions. When you do the same thing, we lengthened it out to 8 years because they have more long-term strategies, but you see a very similar thing, where if they only invested 1%, 2%, 5% into Bitcoin, it improved the annualized returns of that portfolio, it barely moves the overall volatility of the portfolio, and it reduces the risk through diversification because Bitcoin is not correlated with other asset classes. And so we're talking 1%. 1% allocation can make a meaningful difference in the returns of these portfolios while reducing the risk at a time where everybody's looking for uncorrelated assets as inflation disrupts the relationship between stocks and bonds that have been typically used to reduce risk. So So we brought up Michael Saylor. Well, Michael Saylor was the first of its kind to invest in Bitcoin, add it to its balance sheet as a treasury reserve asset. And the reason being was he said that I'm concerned about inflation, I'm concerned about extreme fiscal spending and geopolitical and economic uncertainties. And when I looked out at everything, this is what he said. He said, those factors may well have a significant depreciating effect on the long-term real value of fiat currencies and many other conventional asset types, including many of the assets traditionally held in corporate treasury operations, aka bonds. We find the global acceptance, brand recognition, ecosystem vitality, network dominance, architectural resilience, technical utility, and community ethos of Bitcoin to be persuasive evidence of its superiority as an asset class for those seeking a long-term store of value. Now, that was August 2020 when MicroStrategy allocated to Bitcoin. This is their performance since then. Bitcoin has outperformed every single other asset that MicroStrategy considered for their treasury reserve assets. And so this is just a case study of what potential exists by considering even a small allocation to Bitcoin. And I hope that this presentation helps just open up your mind with not only how Bitcoin works, but how it can be added to a traditional diversified portfolio to help enhance your returns and reduce your overall risk. So that's it for the presentation. I don't know if, Keith, you wanted to follow up with anything else?
No, I was just going to say, to close out, if you've got time, we talked about time and intellectual curiosity and an open mind, but if you have time and you continue to be curious and you have an open mind about this, please let this be the start of your journey with Bitcoin. Continue to dig in, continue to learn, continue to question. I think it might be one of those things that you look back on in a couple years and say, this is like a good event to attend, right? So that's all we have for you today. Thank you.
Big round of applause for Keith Laska and Sam Callahan.